Before the world learned the word Libor, it had already been paying the price for it. A tiny number, small enough to fit on a sticky note, was quietly nudging the direction of more than $350 trillion in financial contracts, mortgages, student loans, corporate debt, swaps, government budgets, all of it swinging on a rate the public didn't even know existed. The real punchline? That number wasn't carved by market forces or forged through competition. It was self-reported by a handful of bankers who treated the global economy the way a bored teenager treats the volume knob on a speaker. Twist it up, twist it down, see what happens. Picture them, leaning back in ergonomic chairs, half smiling as they typed in the estimate that would ripple across continents before lunch. 1 basis point up, 1 basis point down, insignificant to the naked eye, worth millions in the shadows. And while you were out there thinking interest rates were the weather, natural, neutral, inevitable, they were behind the curtain adjusting the climate. The scandal didn't just expose corruption, it exposed fragility. Because if one whispered lie could shake a system built on trillions, what does that say about the system? Libor wasn't just a number. It was the world's blind trust condensed into 5 letters, and the people guarding it assumed, quite reasonably, that no one would ever peek behind the curtain. To understand why the Libor scandal hit so hard, you first have to understand what Libor was supposed to be. Imagine the global financial system as a massive skyscraper, glass, steel, polished marble, the whole thing gleaming under the sun. Now imagine that its entire weight rested on a single narrow steel beam hidden in the basement. That beam was Libor. It measured the interest rate at which major banks claimed they could borrow from each other. Emphasis on claimed, not verified, not audited, not cross-checked, just declared. Like asking the fox how secure the henhouse feels today. In theory, it was elegant. Every morning, the world's biggest banks would send in their best guess, an honest estimate, as the designers like to call it, of what it would cost them to borrow money. Blend those guesses together, trim off the outliers, and voila, the pulse of global finance. Libor was the heartbeat everyone listened to, even if most people didn't know it existed. Your mortgage? Libor? Your student loan? Libor. Your city's budget? Libor. It was the quiet metronome keeping the rhythm of capitalism, but the elegance masked a fatal flaw. The system relied entirely on the honesty of participants. No safeguards, no consequences for bending the truth. It was like setting a giant bowl of candy in the middle of a kindergarten class and trusting the children to take only one piece each. Except these children wore $1,000 suits and had bonuses tied directly to how helpful their Libor submissions could be. The irony is almost comedic. Economists wrote papers praising Libor's efficiency. Regulators admired its simplicity. Banks celebrated its global reach. All the while, the mechanism itself was nothing more than a polite handshake and an implicit promise to behave. A promise that evaporated the moment someone realized that nudging the number even slightly could tilt billions of dollars in their favor. Libor was designed to be the world's financial compass. Instead, it became a beautifully wrapped invitation to mischief, one that many traders simply couldn't resist. Step onto a trading floor during the height of the Libor years, and you'd swear you were watching a high-budget heist movie. Screens glowing like city skylines, voices ricocheting between desks, caffeine-fueled ambition humming louder than the servers. This was the arena where the manipulation happened, not in some smoky back room, but out in the open, disguised as normal business. Traders weren't twirling mustaches or plotting in shadows. They were typing fast, talking faster, and bending a global benchmark with the casual ease of someone adjusting their office chair. The trick was almost insultingly simple. Remember, Libor came from banks submitting the rates at which they said they could borrow. The submitters, the employees responsible for sending in those daily numbers, were supposed to be neutral, monk-like figures untouched by the chaos of the trading desks. Instead, They had traders hovering over their shoulders like friendly devils. All it took was a quick message. "Hey mate, any chance you could keep it low tomorrow? Got a position that'll sing if Libor dips." And the submitter, who definitely wasn't supposed to be listening, would reply with something like, "For you? Absolutely." A global interest rate shifted. A trader's book made millions. And the world kept spinning, blissfully oblivious. These weren't isolated favors. They were daily rituals. It became a marketplace of nudges, whispers, exchanged favors. A trader in London might tug Libor down for a friend in New York. Someone in Tokyo might push it up a notch for a colleague who promised to return the favor next week. They didn't talk like conspirators. They talked like co-workers swapping pens. "Can you nudge 3-month up a touch?" "Sure thing, mate, no worries." Somewhere, a city's debt interest changed. Somewhere else, a pension fund's return shifted. All because 2 guys typed faster than the compliance department could blink. And for traders, the stakes were enormous. A single basis point, 1 tiny 100th%, could swing millions. If you had a massive position tied to Libor, that microscopic tweak was the difference between a bonus big enough to buy a yacht or a bonus barely big enough to buy lunch. So they chased those nudges like treasure hunters. The messaging logs investigators later uncovered read like comedy sketches. "Dude, I owe you a bottle of Bollinger. Make it 2 if this works. You got it, brother." It was greed coated in friendliness, manipulation dressed up as teamwork. And the culture allowed it. No, encouraged it. Banks celebrated profit, not principle. If a trader brought in millions, nobody asked, how? Nobody wanted to. Compliance teams were understaffed, overmatched, and sometimes willfully blind. Libor manipulation spread because it worked, because it was easy, because everyone assumed someone else was watching the store. The truth is, no one was. The fox wasn't guarding the henhouse. The fox was hosting a barbecue. But the most astonishing part is how ordinary it all felt to them. Traders weren't thinking about mortgages in Ohio or student loans in Sydney. They weren't imagining the ripple effects on cities, companies, or families. Their world ended at the edge of the trading desk. Libor wasn't a global benchmark. It was a lever, a switch, a tool. And tools are meant to be used. What emerged was an unspoken cartel built not from secret meetings, but from casual chats, jokes, friendly deals, thousands of micro decisions that collectively warped one of the most important numbers in modern finance. No dramatic villains, no mastermind plotting global chaos, just everyday participants in a system that made dishonesty profitable and honesty irrelevant. By the time regulators finally looked behind the curtain, the chats, emails, and submissions formed a mosaic of manipulation so absurdly casual, it felt surreal. Traders had been adjusting the world's financial gravity as if they were ordering lunch. When the financial world cracked open in 2008, the Libor game stopped being a friendly internal cheat sheet and became a full-blown survival mechanism. Banks weren't just trying to make money anymore. They were trying to avoid looking like they were bleeding out. And nothing, absolutely nothing, revealed weakness faster than admitting you had to borrow at high rates. In a crisis, a high borrowing cost is like showing up to a job interview drenched in sweat and holding a resignation letter you haven't even written yet. So the banks did what scared institutions often do. They lied. Quietly, uniformly, desperately. This was the moment when the manipulation stopped being a side hustle for traders and became a coordinated, industry-wide illusion. The world was falling apart, markets were in freefall, and banks were terrified that a single number, their Libor submission, could mark them as the next domino to collapse. So they submitted unrealistically low borrowing rates, pretending everything was fine, while the financial equivalent of a wildfire burned outside. It was a global chorus of, "We're good, totally fine, nothing to see here," even as their balance sheets were screaming for help. investigators later noticed the eerie synchronization. Banks that couldn't get short-term loans from anyone, not even their closest partners, were magically reporting borrowing costs lower than the rate at which the market itself was lending. It was like claiming you bought gas for $1 a gallon when the entire world could see the station sign flashing $4.29. The numbers didn't match reality, and reality was getting uglier by the hour. At the same time, whispers started creeping through the industry. Journalists spotted anomalies. Analysts wondered why Libor barely moved during days when credit markets were in cardiac arrest. Regulators, who had long treated Libor like a sacred artifact rather than a self-reported estimate, began to sense that the foundation of the global financial machine wasn't just shaking, it was rotten. Inside the banks, panic created a strange harmony. Institutions that normally competed like rival kingdoms suddenly shared a silent pact. Inflate confidence, even if it meant distorting the truth. Libor became the financial world's makeup kit, painting on a calm face while the bones fractured underneath. Submissions that should have reflected chaos instead looked eerily stable, smoothed out like someone ironing the wrinkles out of a burning shirt. And then came the cracks. Traders' chats revealed inconsistencies. Economists pointed out impossible spreads. Central bankers whispered behind closed doors about the Libor problem, a phrase spoken with the same tone you'd use to discuss a tumor you're hoping isn't malignant. Slowly, painfully, the illusion unraveled. The data didn't align with market conditions. The submissions didn't align with borrowing realities. The banks didn't align with each other unless they were coordinating, officially or otherwise. The world had assumed Libor was a compass, pointing true north. Now it looked more like a drunk man spinning in circles. The shock wasn't just that the number was wrong, but that it had been wrong during the most critical financial crisis of modern history. Instead of helping markets navigate chaos, Libor had been used to hide it. When investigators finally stepped in, they weren't uncovering a simple financial misreporting issue. They were confronting a systemic survival strategy, a collective decision by banks to fake strength at the height of the storm. It was deception born not from greed alone, but from fear. Fear of collapse, fear of exposure, fear of a market that had stopped trusting anything or anyone. The 2008 crisis didn't just expose cracks in the financial system. It exposed the truth that Libor had never been the objective benchmark the world believed it was. It was a number built on confidence, and when confidence died, the number morphed into whatever banks needed it to be. And once that truth surfaced, the scandal stopped being a whisper and became a roar. When investigators finally pried open the vault of emails, chat logs, and recorded calls, it was like discovering the financial world's group chat from hell. Not the cold, calculating correspondence you'd expect from a multi-trillion-dollar conspiracy, but something closer to frat house banter, layered over market manipulation. The messages were so brazen, so stupidly casual, that regulators had to reread them to believe they were real. Traders literally typed out their intentions as if no one would ever check. "Bro, can you keep 3M Libor low today? I'll owe you big time." "No worries, mate. Done." One even signed off with, "Thanks for the lunch?" As if altering the world's benchmark interest rate was a friendly favor earned with a sandwich. These weren't smoking guns. They were smoking bazookas. The deeper investigators dug, the more surreal it became. Logs showed traders cheering when their requested Libor manipulations made their positions spike in profit. Others joked about being the Libor kings, unaware that those lines would one day be blown up on courtroom screens. There were even moments of comedy so dark they bordered on tragic, like traders asking submitters to bend it like Beckham or give it a little love tap. Every line read like a confession delivered with a wink. Regulators, scattered across continents, suddenly realized they weren't dealing with a few rogue actors. They were facing an ecosystem, a global culture where manipulating Libor wasn't a crime but a courtesy. investigators from the US, UK, Europe, Japan, Singapore, and beyond coordinated raids demanded records and interrogated executives who pretended to be shocked that such behavior could occur under their watch. But the documents betrayed them. The emails traced patterns across desks, across floors, across time zones. You could follow the manipulation like a trail of breadcrumbs left by people who genuinely believed no one would ever check behind them. Then came the public release of those messages, detonating like a grenade in front of ordinary people who'd never heard of Libor before. Now they were reading lines like, "If you do this for me, I'll send you a bottle of champagne," while realizing that the champagne was effectively purchased with their mortgage payments, their city's debt load, their retirement funds. The outrage was instant and volcanic. Politicians held emergency hearings. Journalists published exposés dripping with disbelief. Talk show hosts mocked the absurdity of billion-dollar banks tripping over their own incriminating chat logs. The fines followed, huge ones. Barclays, UBS, RBS, Deutsche Bank, Rabobank, each slapped with penalties that looked enormous on paper, but barely scratched their balance sheets. Traders were marched into courtrooms, some fired, a few imprisoned. Banks issued statements filled with corporate poetry about lessons learned and renewed commitments to integrity, conveniently ignoring the fact that their own internal compliance departments had been asleep at the wheel for years. But perhaps the most damning moment was when regulators revealed how long the red flags had been waving. Central banks had suspected manipulation. Analysts had questioned the data. A few journalists even wrote about Libor looking strangely smooth during the crisis. The signs were there, ignored, minimized, or waved away because acknowledging them would shatter the illusion that the financial system was built on objective truth, rather than cooperative storytelling. The investigations didn't just expose wrongdoing. They exposed a worldview, one where global finance operated on trust that was never truly earned, and honesty that was merely assumed. The scandal's documents didn't just reveal manipulation. They revealed the industry's psychology, informal, self-serving, brazen, and convinced of its own untouchability. In the end, the world wasn't shocked by the greed. It had seen greed before. The real shock was the carelessness, the fact that the people moving trillions treated the system like a playground, leaving behind written evidence as if none of it mattered. Libor wasn't just manipulated. It was mocked, gamed, distorted, and laughed about. And the whole world got to read the jokes. When the dust finally settled, regulators announced fines that sounded enormous to the public. Billions of dollars splashed across headlines in bold type, as if punitive numbers alone could rebalance the scales. Barclays paid, UBS paid, RBS paid, Deutsche Bank paid. It was a global parade of financial penance. But behind the spectacle, everyone who understood the game knew the truth. These fines were rounding errors for institutions that moved trillions. A few billion to make a scandal go away was just the cost of doing business, a financial slap on the wrist delivered with a velvet glove. And what about the people whose fingerprints were actually on the keyboard? A handful of traders became the sacrificial lambs, charged, tried, and sentenced as symbols of accountability. Some went to prison. Some were banned from the industry. Others simply slipped quietly into new careers, their resumes washed clean by time and selective amnesia. Meanwhile, the executives who oversaw the culture that enabled the manipulation? Many kept their bonuses. Some were promoted. A few retired comfortably to the kind of lives that look suspiciously like rewards rather than consequences. The real cost landed elsewhere, on the people who had no idea what Libor even was. Homeowners whose adjustable rate mortgages ticked up because a trader in London wanted a new bottle of champagne. Students whose loan payments crept higher thanks to a half-baked joke in a Bloomberg chat. Cities that paid millions more in interest on municipal bonds because a submitter didn't want to disappoint a colleague. Pensioners whose retirement funds underperformed because the benchmark meant to guide them had been twisted into a profit lever. The scale of the damage was both massive and invisible. You couldn't point to a single town square and say, "This is where Libor hurt us." The harm seeped in quietly, like humidity. Small rate changes multiplied across millions of contracts, billions of dollars, and years of compounding. People didn't lose their homes in a dramatic wave. They just paid more. Municipal budgets didn't collapse overnight. They just strained further. Pension funds didn't go bankrupt. They just delivered less than they should have. No riots, no broken windows, just a quiet, relentless siphoning of value from the many to the very few. And the industry's response? A round of carefully curated apologies, each sentence polished by legal teams until no one could tell whether it was contrition or public relations. Banks insisted the scandal reflected a limited number of individuals, and not the culture as a whole, as if the messages revealed weren't symptoms of a system shaped around profit at all costs. The public was asked to believe that the world's most important interest rate had been accidentally manipulated for years, like a clerical error on an astronomical scale. In the end, the Libor scandal forced a reckoning, but not the kind Hollywood promised. There were no dramatic takedowns, no sweeping reforms that held every guilty party to account. Instead, there was a faint, uncomfortable recognition. The financial system had allowed a microscopic group of insiders to warp a macroscopic portion of the global economy, and the aftermath would be borne mostly by people who never even saw the crime. This was the bitter truth. The banks paid, but they didn't pay. The traders suffered, but the system didn't change. And the public, as always, footed the bill quietly through higher payments, lower returns, and the lingering sense that the game was rigged long before they ever sat down to play. In the aftermath of the scandal, regulators rushed to rebuild what had been shattered. Not just a number, but the illusion that the financial world ran on objective truth rather than institutional storytelling. Libor had always been marketed as a neutral benchmark, a quiet, dependable constant in a chaotic world. But once the public learned it was built on self-reported guesses from banks with billions at stake, that myth evaporated. The solution, according to policymakers, was reform, new benchmarks, new rules, new oversight. And yet the irony was impossible to ignore. Only after decades of treating Libor like a sacred oracle did the world finally ask whether the oracle even knew what it was talking about. Replacing Libor meant building something less human, less trust-based. Regulators proposed benchmarks grounded in actual transactions, real trades that could be verified instead of polite estimates that could be massaged. Overnight indexes emerged, engineered to be harder to manipulate, stripped of the soft spots that made Libor so tempting. It was the financial equivalent of moving from a handshake agreement to a notarized contract. Cleaner, tighter, less poetic, and far less forgiving. But reform couldn't erase the deeper lesson. The global financial system had been leaning on a pillar that no one had inspected for cracks. The scandal revealed how easily convenience becomes complacency. How a system designed for efficiency can turn into a playground for opportunists when no one is watching closely enough. Libor wasn't just a flawed benchmark. It was a mirror reflecting the industry's blind spots. Its worship of profit, its overconfidence in self-regulation, its habit of assuming that if a rule hasn't been broken yet, it never will be. And for all the outrage, the new benchmarks didn't magically purge the old habits. Human incentives didn't change. Competition didn't soften. Markets didn't suddenly decide to regulate themselves with integrity. The reforms built stronger walls, yes, but the same players still lived inside those walls. The industry pretended that replacing Libor meant burying the past, but the truth lingered. Greed doesn't disappear. It adapts. What the world finally learned, what it should have known all along, is that stability requires scrutiny, not trust. That transparency is not optional, that any system resting on the goodwill of profit seekers will eventually tilt toward abuse. Libor wasn't the first example, and it certainly won't be the last. It was simply the scandal big enough, loud enough, embarrassing enough to force a reckoning. And so the story closes not with triumph, but with a quiet, uneasy acknowledgement. The financial world didn't collapse because of Libor, but it could have. The benchmark failed, the system wobbled, trust cracked, but the machine kept running, patched together with reforms and hope. The scandal became a warning label slapped onto global finance. Do not assume the foundations are solid. Inspect regularly. Handle with skepticism, because if one tiny number could bend the world once, something else can bend it again.